Welcome back to the channel, everyone. So if you're new here, this is me trying to build a passive stream of income in my tax-free savings account. So we're picking stocks that pay dividends and just trying to grow a passive stream of income. So our TFSA is at $11,994.42 currently, and my current goal is to try to hit $15,000. So if you want to follow along with the journey, just subscribe below. We're almost at 200 subs, so thank you so much for everyone that's subscribed already. And if you enjoy the video, please do subscribe. And if you want to help support the channel, you can use my referral links in the description. So you can sign up for Shakepay and earn free Bitcoin every day just for shaking your phone once every single day. Or you can join Wealthsimple, get the value of 2 free stocks valued up to $4,500. Links in the description. So January was the worst month for stocks in a long time. Probably the worst January in quite the while. So if you are a new investor in the market, that might have been scary, but honestly, can't look at the month to month. You gotta look at the long-term view. Just pull out the graph. So February starting off okay for us. So we're about $110.33 or 1%. $53 in the last week, so pretty flat. Not much change there. Up 1% in the last month for $79.17. Past 3 months we're up 3% or $319.19. Past year, we're up 1148.65, or about 11% gain, and all time we're up $1,152.30, or about 11% gain. So let's get into the portfolio and the positions that we updated. So I purchased one more share of Brookfield Asset Management, so it actually recovered quite nicely. Unfortunately, I did want to get more shares of this great business, but I didn't. If you want to know a little bit more about this one, I did make a video pretty recently about this holding if you'd like to know more. I got a little bit more of Scotiabank. So at this one, we just had a few dollars left over. I just put that right back into Scotiabank. I bought one more share of Canadian apartment REITs just because it's dipped a little bit. Real estate hasn't been doing too well during January, so I decided to take advantage, buy one more share, just average down in that position. I purchased 2 more shares of the Ethereum ETF that just pays me a high dividend yield. So this one pays me about a 20% annual dividend yield, and it paid me monthly. So I just received that dividend yesterday actually for $3.50. So about 22% dividend yield for this fund. Great way to get crypto, but also just get a high stream of income because crypto is very volatile. We don't know where the price is going to end up. It could go much higher. It could go much lower. We have no idea. So I like getting high income for this, and I'm keeping it a small position, only 2% from my portfolio. That's what I'm comfortable with. And the new position is actually an ETF. So this is HYLD. This just came out yesterday, and this is just a collection of different covered call income funds that are all holding U.S. blue chip stocks. And the reason why I went for this was because most of my portfolio is holding Canadian stocks. Like I do have a few American stocks like Intel, Apple, Microsoft, and a Chinese stock in Alibaba, but for the most part, I feel like my portfolio is very concentrated in Canada, so I feel like this is something my portfolio needs. It feels a need of income, and it feels a need of just having some exposure to, more American stocks, which I desperately need in this portfolio. So for my needs, this is great, and I'll be going deeper into this in a moment. And we bought a tiny bit more Tesla. We just had a couple dollars, so that's about it for the buys. Here is the website for HYLD. So this literally just launched yesterday. So this is just highlighting the fund. So 10% target yield with monthly distribution, so you're going to get a monthly income. Equal weight portfolio of 7 U.S. equity covered call ETFs, sector mix broadly similar to the S&P 500. And you can buy it in Canadian dollars. You can also buy it in American dollars if you want. And they are investing in diversified blue chip U.S. equity exposure. So blue chips are like very high quality, well-established companies you've heard of, like Apple, Coca-Cola, stuff like that. And then they say that it's going to be a higher yielding alternative to the S&P 500. So that's just a collection of the 500 largest companies in the United States. And they say that they have enhanced growth potential and yield by adding modest 25% cash leverage. So this fund can actually borrow money at a much lower interest rate than a retail investor could. So it's a great way for them to get more income and have more money to play with because they can take advantage of low interest leverage, whereas a retail investor can't. You would be borrowing money at a very high interest rate, so that could be quite risky, but this is just a great way to deliver that solid 10% yield every single month, just hitting your account, and that's basically going to be matching an S&P 500 ETF, which is going for growth, but if you want income, this could be right up your alley. And over here, they just have the ticker, so it's HYLD, and the unit NAV is 1629, so that's what they believe these shares are currently worth. And it went up 15 cents the first day, so it's literally only been out one day, and here they are just showing the yield percentage versus the S&P. So 10% for HYLD, 1.38% for the S&P 500, and this is just showing you the sector allocation. So pretty diversified fund overall. So you have technology, consumer, and here are the holdings. So the first, I'm familiar with most of these ETFs, so I'll just touch on them briefly. So Harvest Healthcare Leaders Income ETF is just a diversified pharmaceutical companies. So like think your Johnson & Johnson's, Pfizer, stuff like that. It just holds these funds and those stocks, and it just pays you about 8% monthly yield. Harvest Brand Leaders is just taking really strong established brands. It's just an ETF that just pays you monthly income based upon just having a strong brand. So again, Apple, Coca-Cola, the strongest brands in the world, Nike, stuff like that. This fund's been doing pretty well. XYLD is actually the S&P 500, but it's a covered call ETF. So again, all of these funds are just writing options contracts. So they're offering to sell a stock at a certain price, and the buyer has to pay a premium to try to buy it at that price. So for example, let's say a stock is $100, and the fund wants to sell a contract to sell it at $105, and the options buyer wants to pay us, let's say, a $2 fee to have the right to buy it at $105, and say the fund goes up to $110. Well, the fund would actually have to sell the stock at $105 despite it going up to $110. So you give up a bit of upside, but you get that income right now, which is how they're funding this high yield every single month. But let's say the stock hits $104, it doesn't hit the strike price, then we just collect the $2 options premium from the buyer. They don't get our shares. We just made extra income from our portfolio, not losing any shares. We still have all our shares. And we can write a covered call option next month to just continue making more and more income. And then the other one here is Horizon's Enhanced Income Gold Producers ETF. So this is essentially just gold producers, gold miners, and again, another monthly income fund. Global RYLD and XYLD. So this is the S&P 500 covered call. RYLD would be the Russell 2000. So this would be like a collection of 2,000 small caps companies. So think companies that are like $2 billion in value or lower. So there's a lot of companies in this basket of stocks that have the potential to grow. So it's done pretty well historically, and it's a lesser known fund. QYLD is going to be the NASDAQ 100. So this usually favors more technology companies. So you know a lot of companies on NASDAQ like Apple, Tesla, stuff like that. And the final fund is just TXF. So this is an actively managed like technology fund. I actually used to own this one directly. So this one pays a pretty good yield. This one is a bit more active. So what that means is they change the stocks from time to time depending on where they see value in the technology sector. And again, they just use call options to generate lots and lots of income. So the great thing about this one is that they're just going to equally weight all of these ETFs. And you don't need to have, 1, 2, 3, 4, 5. You don't need to have 7 different ETFs in your portfolio. You could just have this one holding, make your portfolio very simple, especially if you're looking for really, really high passive income. This could be a great choice for everybody. And the management fee is 0.65%. So what that means is for every, $100 you have in the fund, you're going to pay like a 65-cent annual fee. But then again, you are getting paid a annual income of $10 or more. It just depends what you get your shares for. So overall, I think that this is a great fund for people that want to get U.S. exposure and need income, because it's going to provide a very similar return to the S&P 500, just because if you get a 10% yield, you are essentially getting what the market gets, which is 10%. So getting that every single month and being able to use that as income if you're closer to retirement or you are retired, or if you just want extra money in your portfolio to just, invest in opportunities from month to month, this is a great option for people. So let me know what you guys think of this one. If you want to know more about the individual holdings in the ETF, do let me know in the comments. I can definitely run through it a little bit more than I did in this video. I can't explain all of them in great detail because I think I'm limited to 15-minute videos. For the dividend growth process of the portfolio, we've actually hit a milestone. So I've finally hit $50 a month in average monthly dividends. So that's another milestone we can cross off the list. So this is fantastic. That means every 2 months we're earning $100 in passive income from the portfolio that we can use to reinvest and earn more dividends over time and start compounding our returns. And my next goal is to reach $2 a day in dividends. So to do that, I just need to hit about $60 a month in dividends. So we can definitely do that. I remember even a few months ago we were under like $40 a month in income. So to hit $2 a day, we just need to get another $10 a month in income. So not tough to do. $165 every day. So to hit $2 a day, we need to hit $60. So we're not far off from this. So it's very encouraging to see that it's definitely working, and we're hitting our goals, one step at a time. We're not trying to do crazy unattainable goals, just because that's very demotivating, especially if you're starting or you don't have tons of money. You're just throwing in any spare change you have, anything you're saving from month to month, just trying to cut back your expenses as much as possible and just trying to grow that investment account as fast as you can. Just because, the more you put in today, the more it'll benefit you in the future, especially over long periods of time. All right, so thank you so much for watching the video, and please subscribe if you haven't already, if you enjoyed the videos, just because we're very close to hitting 200 subscribers, so I'd like to hit that fairly soon and just grow the audience for the videos and just get, more comments, more views in the comment section, because I'd like to hear how your portfolios are doing, or anything you're learning about the stock market. That'd be great to have in the comments. So have a great day, everyone.